In 2020, an attacker stole $5.6 million from cryptocurrency exchanges in a single weekend. And the method wasn't hacking, wasn't phishing, wasn't a bug. They simply rewrote history. They reached back into the blockchain's past, erased a transaction that had already settled, and walked away with both the money and the coins. That's a 51% attack, and understanding exactly how it works reveals something unsettling. For the right target, the math actually favors the criminal. To understand how that's even possible, you need to understand the one rule that holds every blockchain together. The valid chain is whichever chain represents the most cumulative work, the longest chain. Every node on the network independently follows this rule, so they all stay in sync without trusting each other. That single rule is elegant, but it contains a hidden vulnerability. It doesn't care who did the work. If one entity does more work than everyone else combined, their version of history wins, automatically, by design. The threshold where that becomes possible is exactly 51% of the network's block production power. The mechanism works step by step, and the order is not optional. Skip a step or do them out of sequence and the attack fails completely. Step 1. Acquire more than 50% of the network's hash rate. Step 2. Start mining a secret shadow chain in private while the honest network keeps building the public chain. Step 3. Deposit coins to an exchange, wait for them to confirm on the public chain, then sell and withdraw real money. Step 4. Release your longer shadow chain, which never contained your deposit, and the network automatically adopts it as the true history. Your deposit transaction simply never happened. The exchange already paid you out, and now it can never claw that back. Walk through the Bitcoin version concretely. An attacker deposits 1,000 BTC to an exchange. Bitcoin exchanges typically require 6 confirmations before crediting a deposit. That's about 60 minutes of honest blocks being added. During those 60 minutes, the attacker is also mining their shadow chain in secret. They wait for 6 confirmations on the public chain, then sell the BTC for dollars and request a wire transfer. Now they release their shadow chain, which is 7 blocks deep and never included the deposit transaction. Every node on the network sees a longer chain and adopts it instantly. The exchange's ledger shows the deposit never arrived, but the dollars are already gone. The exchange absorbs the entire loss. How long does it actually take to build that 7-block lead? That depends directly on how much hash rate the attacker controls. With 60% of the network, the attacker produces blocks at a rate of 0.6 per 10 minutes. The honest chain produces 0.4 per 10 minutes. The net lead rate is 0.2 blocks per 10 minutes. The attacker gains 1 block of advantage every 50 minutes. To accumulate a 7-block lead, that takes 350 minutes, or roughly 6 hours of secret mining. Drop the attacker's share to just above 51%, and that same 7-block lead takes over 23 hours. Every fraction of a percent below 60% dramatically stretches the attack window, which also stretches the rental cost and the exposure time. Now attach a price tag to that window. Acquiring hash rate isn't free. You either buy hardware or rent it. Markets like NiceHash publish live spot prices for rented hash power, which means you can calculate the cost of a 51% attack on any chain before you execute it. For Ethereum Classic in 2020, the total network hash rate was about 3.5 terahashes per second. Renting 51% of that on NiceHash cost roughly $3,500 per hour. The attacker ran the attack for about 12 hours. Total rental bill, approximately $42,000. That's not a typo. $42,000 to seize control of an entire blockchain network's transaction history. The question is what they could do with that control. And the answer is where this gets alarming. The return on that $42,000 was staggering. The ETC attacker double spent approximately $5.6 million across 3 exchanges in those 12 hours. Subtract the $42,000 in rental costs, and the margin is extraordinary, roughly 133 times the investment before accounting for any price impact. That's not an edge case or a theoretical scenario. It happened 3 separate times to Ethereum Classic in 2020 alone. The reason it works is that ETC's total network value was small enough that the cost to dominate it was trivially low relative to the liquidity available on exchanges. The attack was economically rational, even cheap, but that same calculation, run on Bitcoin, produces a completely different answer. The profit window isn't infinitely wide, though. 3 forces compress it simultaneously and independently. First, confirmation thresholds. The attacker has to wait for the exchange to credit the deposit, which takes real time during which they're paying for rented hash power. Second, price collapse. The moment an attack becomes public, the targeted coin's price drops. In ETC's case, about 7% on the day. If the attacker still holds unrealized ETC when news breaks, that 7% comes directly off the gross haul. Third, liquidation speed. The attacker must sell and exit before the market panics. Each of these factors narrows the gap between gross theft and actual net gain, and they operate in parallel. Miss any one of them and the profit shrinks fast. Now, run the same math on Bitcoin. Bitcoin's total hash rate is approximately 500 exahashes per second in 2024. An attacker needs more than 250 EHS sustained. That's more than all the ASIC mining hardware currently deployed by every company on Earth combined. You can't rent that. There isn't enough for sale on any hash market. To own it outright, you'd need to manufacture and purchase ASICs worth roughly $20 billion at current prices. What's the maximum you could steal from a single exchange? Most large exchanges cap single-day withdrawals at around $10 million. So the arithmetic of the Bitcoin 51% attack is, spend $20 billion to steal $10 million. That's a return of 0.05 cents on the dollar, before electricity, before the asset price collapses, before the network hard forks to invalidate your work. This is the structural difference that separates Bitcoin from Ethereum Classic or Bitcoin Gold. Vulnerability to a 51% attack scales inversely with total network hash rate, or more precisely, with the dollar cost of acquiring majority power. When that cost drops below the potential double spend value, the attack is rational. When it's orders of magnitude above it, the attack is irrational. Bitcoin Gold in 2018 sat firmly in the rational zone. Renting enough hash power cost roughly $70,000, while the attacker double spent approximately $18 million across exchanges. That's a 257 times return. One of the cleanest cost-benefit cases ever documented in crypto crime. Plot these cases on two axes, attack cost on one side, potential double spend profit on the other, and the picture becomes sharp. Bitcoin Gold, Ethereum Classic, and other small proof-of-work chains cluster in the region where cost is low and profit is high. Economically rational attacks. Bitcoin sits alone in the opposite corner, where cost is astronomically high and profit is capped by exchange limits far below that cost. The line between those clusters isn't technical, it's economic. The chains that get attacked aren't less sophisticated, they're just smaller, which makes their hash rate cheaper to dominate. Security, in proof of work, is fundamentally a function of how expensive it is to be the majority. So what do you do if you're running a small proof of work chain with a low hash rate? There are 4 distinct defense mechanisms, and each one attacks a different variable in the attacker's profit equation. Raising confirmation thresholds. ETC moved to 500 confirmations after the 2020 attacks, stretches the attack window, dramatically increasing rental cost. Checkpointing freezes recent history at regular intervals, shrinking the maximum reorg depth an attacker can achieve regardless of hash power. Merge mining borrows hash power from a larger chain, raising the effective cost to dominate. Proof of stake replaces hash rate entirely. Each approach is real, each has trade-offs, but they all converge on the same goal: make the attacker's cost exceed their realistically collectible profit. Proof of stake deserves special attention because it doesn't just raise the cost. It changes the economics in a fundamentally different way. In Ethereum's proof-of-stake system, a 51% attacker must stake more than 50% of all ETH locked in the network. At 2024 prices, that's over $100 billion just to enter the attack. The punishing part comes next. If the attack is detected, and the protocol is designed to detect it, the attacker's entire stake is slashed to zero, not partially penalized, zeroed. The mechanism is called slashing, and it means a failed 51% attack on Ethereum isn't just unprofitable. It's a mechanism for voluntarily transferring over $100 billion to the rest of the network. Step back and look at what all of this adds up to. The 51% attack is not a mythical threat or a theoretical edge case. It's a documented, repeatable crime that has worked cleanly on the right targets. But the right target is doing enormous work in that sentence. The attack requires majority hash power, a secret chain built over hours, a coordinated deposit and sell on an exchange, and a rapid exit before price discovery destroys the profit. Every one of those steps has a cost, a time constraint, and a failure mode. On small chains, those costs are low enough that criminals have cleared 18 million in a weekend. On Bitcoin, those costs are so astronomical that the attack is functionally equivalent to spending $20 billion to win a $10 million lottery. The chain's security isn't magic, it's just very expensive arithmetic. The deeper insight is that blockchain security was never about cryptography being unbreakable, it was always about making the attack more expensive than the reward. Satoshi's original insight wasn't, "we'll make fraud impossible." It was, "we'll make fraud unprofitable." That works perfectly when the network is large. It works dangerously poorly when the network is small. Every chain that has ever been successfully 51% attacked failed the same economic test. Their total hash rate was cheap enough to rent, their exchange liquidity was high enough to make the double spend worthwhile, and their confirmation thresholds were low enough to keep the attack window short. Fix any one of those three variables and the attack stops being rational. The chains that survive are the ones that stay expensive enough to dominate that no attacker can make the numbers work.